I am Jeff Manthe, and I own and operate a company called Compound Profit. I'm actually based up towards St. Cloud, west of the Twin Cities. But my company, I always like to say I love to work with new, used, and abused companies, and that's where most of my business comes from. Businesses that kind of are off the radar screen of traditional banking, either because they haven't established a financial track record, or they've had a track record, but they've had some problems. Their business has fallen on hard times. They've had a sudden departure of some staff, or in some measure, they've been troubled. They've been beat up. And I find ways to help them recover kind of off the traditional banking path. I would tell you most of my best referrals, most of my best leads come from banks, because they realize in trying to help their customers that there are circumstances that won't allow them to provide the traditional financing that they need to get to the next level. It may be to first base to really get themselves well launched. It may be to get them around the corner if they've had a hard struggle. One of the systems that I use oftentimes to help customers is factoring. Factoring is essentially the ability to help customers find their way to get to the next sale. Factoring, I'm going to go over a number of different things here today. Definition, first off, a little bit of the history of factoring, who can use it, a few case studies of how it's worked for others, and then kind of give you the opportunity to say, oh, I see how I might be able to finance my company through a certain circumstance or a general circumstance. Definition of factoring. It's not a loan. It's essentially selling accounts receivables or selling purchase orders for cash, for immediate cash. So you may have accounts receivable. Guess what? That paper in your drawer is not cash. That paper is paper until it becomes cash. And for some companies that can be Randy did a good job saying, hey, one of the ways you can help yourself is to be defined in the terms you offer customers, be clear on that, and in some cases accelerate that. Get your customers to pay in 10. Get your customers to pay in 15. And I would tell you that when you can do that, that's great. I've seen more often where, especially recently, it's been the opposite of that. Good customers, instead of wanting to pay in 15, are stretching 30 to 45 or 60. And you still want those customers, so you want to find a way to accommodate. Let me go into the next thing. There's really three parties in factoring. There's the factor, me, or several others around the country and around this area. There's the client, that would be you, and then there's your customers. One of the reasons that factoring can work for you, even if you're brand new, or you've had some problems in your business, is that it doesn't rely on your credit, doesn't rely as much on your history as it does on the history and the credit worthiness of your customers. Yeah, we want to know that you as a company, you're making some widgets, you're providing service. We want to know, we need to know that you're going to deliver that when you say you're going to, with the quality that you've promised. But outside of that, we assume that that's going to be done when the invoice is actually issued. We're more concerned about how well do your customers pay you. Do they pay you in 30 days? Do they pay you in 45 days when they promised or when you've agreed? Or do they stretch it out? That's the issues we have to work through. Again, definition. For factoring, there's different levels, and my company works with all levels, and some factors work only with certain segments. There's full factoring, which basically you would say, I'm turning over my whole book. Everything I've got coming in, all the invoices I have, I'm turning those over to you, and you're going to collect those for me. And you're going to pay me for those tomorrow so that I've got cash flow. That's full factoring. There's also what we call spot factoring. Spot factoring is where you may say, I only need help with this one customer. I have this one customer, and every time that comes through, it creates such a surge for me that it really just, whacks my company and, knocks me alongside the head. I need help with that invoice or that customer or that season perhaps, of the year when I just get bowled over with that activity that just really sets me back. That's really spot factoring, where you're picking an invoice, you're picking a customer, you're picking a season, and it's kind of it's not really one-off, but it's limited in terms of its scope. Okay, there's different ways that you can factor. You can say, okay, I just want to do this one thing and I want to be done with it. In other words, I want to give up all responsibility for that. Well, that's kind of called a flat fee, or that might be called a non-recourse, where you're basically saying, I want to be done with this thing. When I sell this to you, Jeff, I don't want to ever hear about it again. That's considered to be a limited or a spot factor, where you're saying, I'm relinquishing anything. That's going to cost you more, because now the factor, namely me, has some liability for whether or not that can be collected. So if that can never be collected, I own that, I eat that. Most often factoring, especially for small companies in the industry in general today, is called recourse factoring. Recourse factoring is essentially where you sell me your invoice, but if it doesn't get paid in 90 or 120 days, I'm going to sell it back to you. So you don't give up, you give up the responsibility to collect on it, but you don't give up the ultimate liability for that until it actually is paid. I'm not going to go over that. This is the most common one, the partial advances for reserves. So for example, a traditional in factoring, just so you get an idea of what this would cost, let's say you have, I'm going to look at the chart here because I want to make sure I don't. Let's say you had a $1,000 invoice, which is what it says on the board, so that's kind of convenient. It matches up. A typical rate on factoring is going to be 2 to 4%. Now that's not an interest rate, that's essentially a discount rate. So ultimately, if it's 2%, that's going to cost you on a $1,000 invoice $20, right? But let's say here it's 4% on a $1,000 invoice. Typically, you get 80% of that the day after you issue the invoice. Cut the invoice, you get it to me. The next day, you've got 80% of that. They don't usually advance you 100%. They usually give you a partial. 75, 80, 85 is typical. So the next day, you've got $800. Keeps your cash flow rolling through. Kind of limits a little bit what Stephanie was saying before about you got these gaps in between here where you just haven't got the reserves to continue doing the daily business the way you want. It eliminates all of the valleys. It kind of levels out your playing field throughout the month. At the end, when the customer pays, let's say you got 30-day terms, 30 days later, we get the payment for that invoice. We refund to you as the client the remainder of that $1,000 less our discount fee. So it would be $200, $1,000, you got $800 up front. Now you've got $200 left. When the customer pays you, we give you $160 back and we keep the $40 as the factor fee, discount fee. What you've gained from that is cash flow, cash flow, cash flow. That keeps everything moving. A little off the topic here, but one of the things that's remarkable sometimes is companies that I speak with saying, hey, I'm doing so great, I'm out of business. They run out of cash literally because they just can't keep, so they have to do something that seems a little crazy, like they have to stop, they have to stop taking orders, or they have to slow down the order taking because they can't support, the cash flow won't support the forward movement of their company. One of the things about factoring is you will never, in a growth surge, you will not run out of cash. You will always be cash flow positive. And it's really a great tool for companies that are growing aggressively because they won't outstrip their cash flow. They won't restrict their ability to grow as quick as their ideas and their ingenuity is going to take them. it really lets them go. Yeah, question, go ahead.
How about the healthcare industry where you deal with insurance, like let's say on like auto or work comp, you know, it's, you're gonna get it, but you know, 30, 60, 90, 5 years, whatever.
Right.
Does this work with that?
It can work with it. I think one of the concerns we always have in factoring with healthcare is the role of insurance in the middle of the process.
Yeah, that's right. So more specifically, auto versus private insurance.
Right. Auto insurance generally works pretty well. It's more in the personal and the healthcare area where it gets tangled up in, you know, slowdowns, or it gets tangled up in, well, this really wasn't that code, that service really didn't apply. So what seems like a fairly straightforward thing when you first go to the doctor ends up being a myriad of recodings or realignments, and that of course the way factoring works is, you know, it's on the clock. You know, you're paying by days, and if it stretches out, you know, longer, that clock is still running, so it can get to be kind of a nightmare. And so sometimes what we've done with that is finding areas where it seems it's more stable. Doesn't necessarily mean it's faster, but it means it's more stable in terms of when you typically will get the payments to come through. But it works there as well. It works for staffing companies where their biggest thing is they've got payroll, so they can keep that, you know, keep ahead of that payroll surge. I'm going to go really fast over this history of factoring because it's interesting, but it really doesn't mean anything for today. Factoring is not a new thing. It goes way back. I mean, the Phoenicians, the Romans were known to deliver payment for product and then collect on it later. Pilgrims' journeys to the United States were largely financed with a primitive form of factoring. In fact, really it was Great Britain where a lot of the more recent factoring has been very common, very well practiced oftentimes. In the United States, it really didn't start till the early 1900s, and primarily it started East Coast in the textile industry. A lot of carpeting, clothing, did a lot of factoring to help those companies as they were surging in their growth. And really it started to work for small businesses only about in the early 1980s is when it was expanded such that small business could really start to take part in it. Before that, it was really large institutions that were able to do factoring. And so today, it's open to pretty much any company. We already talked about non-recourse versus recourse. Non-recourse, basically the factor owns it, lock, stock, and barrel. You sell me that invoice, it's mine, you've got no liability. Typically that's going to be a lot more expensive because of the liability that I've now assumed. And so that's something to say, well, you may have a case where that makes sense for you, but for the additional fee and say, you know, I believe this is going to be collected. So I don't need to go there. And in some industries, we won't go there. We won't take that liability for those industries under any circumstances. It just isn't done. We talked about non-recourse and recourse. Here we get a little bit about, you know, kind of the levels and how it's changed and where my company kind of fits into the equation. The very large deals, the GEs handle a lot of that. The CITs, those are multi-million-dollar invoices that they're handling at a very big level, and the fees on that might be pretty small, but they're mega deals. The larger banks are dealing with a lot of what's called recourse factoring, but they're usually dealing with companies like that. Stephanie mentioned Target earlier. Target does a lot of factoring, but those are almost all million-dollar type invoices, and Target basically says, we're not using it because we have to. We're using it because we believe, we know we can make more money using factoring dollars than we're pulling our own reserves. So we're using our own reserves for other ways that we can generate more income, more revenue. We use factoring to cover this, and this throughput allows them to continue to surge their businesses forward. So very big companies, yes, go ahead.
What would be the advantage of using factoring instead of a line of credit? Why would you not just use a line of credit?
There's several reasons. A lot of companies would have both. But the line of credit, and what I've found tragically in the last couple of years, a lot of companies who used to use their line of credit to cash flow their way through, two things have happened. One, their lines have been cut down. So maybe they had $100,000, maybe they had a $200,000 line. Guess what? Now it's $75,000 or $50,000. So what they used to use to flow that business isn't available to them anymore. The other reason is the line of credit actually shows up on your balance sheet, and so it's perhaps going to limit what else you might be able to borrow for equipment or for something in an expansion project. So there's nothing wrong with lines of credit. I love them. I offer some. But in this circumstance, if you're in the accounting area, basically this is not a balance sheet transaction. You're basically, so you're leaving those lines open for other purposes that might be more beneficial to you down the line. Yes, Jeff?
I don't know. Can you really say that, though? It's not a balance sheet transaction if you're dealing in a recourse situation? Because it's still, it's really, a recourse situation.
Right.
It's not,
you can make that argument. I understand that exactly. Because you still have that back-end liability.
Yeah.
And depending on how the accountants would treat that, you still might have that.
That's always a question. It's kind of weird how you would treat that.
I don't know, Stephanie, what do you see about that?
It is certainly. I see your argument that it's not considered debt. It's not a payback. I got to pay back this debt, and it's that $160 you mentioned earlier that you're really on the line for. So it's a fraction of the original, and you're not actually on the line for it. It may never come your way either, just like a normal AR.
Right.
So it's being considered a receivable that's yet to be collected, not debt for your line of credit and loans.
So but I understand exactly what you're saying. You haven't relinquished all liability, but typically if you go and try to get a loan and you've got a bank line, that's the first thing they're going to say, well, you already have that. And then now you're going to try to get this. Receivables generally aren't looked at in the same way. And now you get down below, you get into recourse, smaller business, these tiny biz ones down at the bottom, and we've done factoring all the way for a single invoice of $1,000. Now, we did that for a specific reason, and it was a brand new startup company. They just needed to get something going. They were able to get an invoice generated, and we got them some real base startup funding on that invoice. Now, that company eventually, and it's one of our case studies, years later, that's a trucking company that's got 400 trucks that is the dominant player in all the Dallas metro area local trucking, and became very successful, but it all started with one invoice, with one person and one truck that was able to get something going just because they were able to get $800 on a $1,000 first-time invoice. So small things can lead to much, much bigger and more successful enterprises. Yes, question?
You were saying about you could have factoring if you had a line of credit and needed more money with the factoring. How do the banks view factoring, given that a lot of times that the line of credit, they have collateral and all the accounts receivable?
That always has to be negotiated with the banks. If you have a line of credit, especially if the bank has a lien on your receivables, and that's something we have to work through with the bank, or it won't happen with us.
Are the banks pretty cooperative about it?
Yes, I would say 95% of the time. The banks are interested in capital. They are not as tied, I won't speak for Randy, but they're not usually as tied into the inventory or the accounts receivable. So they're willing, and remember, a lot of my leads come from banks. So they're saying, hey, what's best for this client, which will ultimately be best for our institution, is that they're successful in cash flow, getting themselves to a better cash flow position, and ultimately making more money or making money. And so they're willing to work to say, we can open this up and we'll relinquish our position just on these receivables that you're talking about. So we become the first on those receivables, and the bank will then take second on that. But yeah, we've had good success working with banks to get us that position just on those receivables. Other question? This is an example of a staffing company. This is an actual client. I don't think the name is the same, but they were West Coast, worked with Microsoft. This wasn't my particular client, but big customers, big companies. 2 minutes, okay. Basically, they had 50 employees. Their monthly total was $208,000 in payroll. It was killing them because they were billing 1.5. They were billing $312,000. Basically with factoring, they had a positive cash flow even right away, $41,000 a month. That allowed them to continue to move things forward. I guess ultimately the question you have to answer in using factoring is this going to make me a better and a stronger company? Is it going to let me get to the next level? If the answer is yes, you ought to consider it. And we talked about some of these, basically on the bottom line, this is going to give you unlimited capital. If you're a surging forward company, a successful company, growing, this will allow you to surge forward with no interruption. You can grow as fast as your sales group will allow you to go without running out. Let's see if I have anything else. These are a couple of examples that we actually use. This custom drivers was the invoice I referred to earlier up on the top. We had one, it was an $1,100 invoice or something they cut. It was a company that had gone essentially out of business. Prior owners gave her the truck and said, do what you want with this. She was the administrative person, and she had a regular standing order from this one company. And they said, can you generate an invoice? They said, yeah, we can get an invoice. Okay, we're going to get you some money so you can put fuel in that truck tomorrow. And from that, it's a Dallas-based company. It's got over 400 drivers. It's about a $12 million business today. And that's only 2.5 years ago. So there are some success stories with factoring. The last thing people ask me all the time, and I promise, Pat, I'm going to give it up here. What do customers think if you factor? Do they think poorly of you because you're actually using another company to work on their accounts receivable? And what we have found typically is customers appreciate you're partnering with a receivables management group that's really going to help you and help them continue to be able to work together. Especially if you're working with bigger customers, they like the security of knowing you're doing what you need to do in your receivables to be on top of it. They want you to succeed. They want to give you more business. They want to give you business when their terms of 30 or 45 days, you can handle that. And they want to grow the business along with you. So we've never had an issue with any customers of our clients saying, I don't like the fact that you're working with a receivables management company. So it's never been an issue. I think it's cutting me off now because it doesn't want me to do this. Okay. I'm going to get right to me there. Thank you very much. Any other questions? Last questions? I've got business cards on the table back there, so afterwards, feel free, and flyers, feel free to stop by.